Hi, and welcome to the Professional Options Trading course, Lesson 1. I'm Khoo, and in this first lesson, we're going to focus on the basics of options trading. So let's begin by asking this question: why use options? I'm sure some of you are investors. You've taken maybe my value momentum investing class, and you're holding a portfolio of really good companies, and you're investing for the long run. Or some of you may be short-term swing traders, and you may have taken my professional stock trading course. So whether you are an investor or trader, options will help you to profit under all market conditions. So whether the market goes up bullish, goes down bearish, goes sideways neutral, goes in circles, with options, there's a way to profit under any market scenario. So options are kind of like a Swiss Army knife. It's extremely flexible. You can combine different option strategies to achieve what you want, again, under different market conditions. Specifically, by using options, it will allow you to, number one, lower your risk and lower the capital required. Again, whether as an investor or as a trader. The second thing options can help you do is to increase your ROI, your return on investment, or your return on your capital. Helps you to boost your returns. For example, as a long-term investor, if you have taken my investing class, you know that if you just buy the index ETF, in the long run, you're getting about 9 to 10% a year. If you pick fundamentally good companies that beat the index and you buy them when they're undervalued, over the long run, you're getting somewhere between 15 to 20% return a year. But with options, you're able to turbocharge your portfolio returns from 15 to 20% return a year to up to 30, 40, 50% returns a year. And the best thing is you can boost your returns while at the same time lowering the risk of your portfolio. The next thing is options can also help you to increase your win rates when it comes to short-term swing trading. The reason is because with options, there are certain strategies, for example, like credit spreads, where we teach in the advanced trading course, where you can get a 90% win rate on your swing trading strategies. So again, options can be used whether you are an investor or you are a trader. As for me, I'm both. I've got an investment portfolio where I buy companies and I hold it for the long run. I also have a trading portfolio where I perform swing trades. I go in and out, taking quick profits from the markets. So in this options course and the advanced course, we'll be covering all the different ways you can use options. So as an investor, there are basically three main uses of options. The first is we use options to sell covered calls against the stock that we own in order to earn additional monthly income of anywhere between 2% to 3% a month. Now, 2 to 3% a month, if you analyze it, it's like 24 to 36% a year, even if the stocks go sideways. Now, at this point, you may not know what the heck is a covered call. So again, we'll go through this in detail in the lessons to come. But I'm just giving you an overview of how we use options. The second way investors can use options would be to buy stocks at a discount, a huge discount sometimes, or even sometimes buying stocks for free. Yep. And we can achieve that by selling cash secured puts. Again, at this stage, I don't expect you to understand what it means because we'll be covering that again in the subsequent lessons. But by selling cash secured puts, basically we are getting paid to wait for the stock price to fall to our desired buy level. And we are paid, again, anywhere between 2% to 3% a month, which is again about 24 to 36% a year. As investors, we can also use options to protect our portfolio from short-term corrections or bear markets. In the long run, the stock market will always go up. We know that. Good companies we invest in will always go up. but in the short term, they could go down for a couple of weeks or months. Now, while it's going down, we can actually generate short-term profits and use the profits to buy more stocks. And how do we do that? By hedging our portfolio using options. We either use put options, we buy put options on the index ETF, or we buy call options on the VIX or the volatility index. Again, don't worry about all these terms. If you're new, you may be very confused about these terms. We'll cover them in detail in the lessons to come, just giving you an overview right now. So again, for investing, 3 ways we use options: selling covered calls, selling cash secured puts, as well as buying put options on the ETF or the index to hedge our portfolios. Now, when it comes to short-term trading, there are many strategies that you're going to learn in options. We have directional trading. So what's directional trading? It's when you take a bet on the direction of a stock or the market. For example, if you are bullish, you go long. You want to buy low, sell high. If you're bearish, you go short, sell high, buy low. So instead of buying the stocks itself, we can use options to replicate the stocks. And you learn things like debit spreads and credit spreads. So again, why use options instead of just buying the darn stock? Because again, with options, we use much lower capital. We lower our risk and we get much higher returns on our capital, our ROI. Next, we can also use options for non-directional trading. So non-directional trading means you have no idea where the market's going to go. You've got no idea, is the stock going to go up, going to go down? I've got no idea. And we call that non-directional trading, where you profit regardless of the direction. Pretty cool? So we use strategies like the Iron Condor, the Calendar Spread, and the Snipex, where we profit even if the stock or the market goes sideways, goes nowhere, or goes in circles. The third way we use options in trading would be for event-based scenarios. What's an event-based scenario? For example, Brexit, the US elections, the company is going to announce earnings. Now, the thing is, when a company announces earnings or during elections, we have no idea what's going to happen. Is the price going to go up? Is it going to go down? We've got no idea. But we know one thing for sure, that volatility will increase. So you can use certain strategies to profit from the increase in volatility, regardless of the price direction. So certain strategies would include the earnings probability spread, where we use this to trade on earnings when companies announce earnings, and the earnings sniper spread. And again, some of them will be covered in the level 1 options course, like we'll be covering this, and debit spreads in the level 1 course, options Iron Shell. And in options Iron Striker, which is the level 2 advanced class, we'll be covering credit spreads, back ratios, non-directional trading, and event-based trading. And once you've learned all these different strategies, you have the confidence to conquer the markets and profit regardless of market direction. Whether the market goes up bullish, goes down bearish, sideways neutral, or high volatility, low volatility, it doesn't really matter. So if you're excited, let's get started with the basics to understand what's an option in the first place. So the first thing to understand is that there are only 2 types of options. You've got call options and you've got put options. That's it. Sounds simple? Okay, so let's begin with a call option. Now, when you buy a call option or you sell a call option, you're essentially buying or selling a contract. An option is a contract. So let's imagine that you are a buyer of an option. So when you buy an option, you're buying a contract that gives you, the buyer, the right. Again, repeat this, write this down. You have the right. You have the right to buy 100 shares of the underlying stock at a specific agreed upon price. And we call that the strike price. So in other words, when you buy a call option, you have the right to buy a certain stock at a locked-in agreed price, the strike price. And you can buy the stock at this price anytime before or on the chosen expiration date. Now, in the US market, one contract is always equal to 100 shares. But this is different for different markets. For example, in Hong Kong, there are certain stocks in Hong Kong where one contract equals to 500 shares. But let's focus on the US market for now. So here's an example of what an options contract looks like. This is the Microsoft December 200 strike call option. So what does this mean? So let's imagine right now that Microsoft, the stock price itself, is selling at $200. And you think that the price is going to go up. You are bullish on Microsoft, okay? So you decide to lock in the price. So what you do is you buy, again, this Microsoft call option, and you choose the strike price of $200. So what does this mean? It means that you have now locked in the purchase price at $200. So you have the right to buy Microsoft shares at $200 anytime before the expiration date. So in this case, the expiration date would be December. And if it's not mentioned, it will be the third Friday of December. So monthly options typically expire on the third Friday of every month. But nowadays, certain stocks, they also have weekly options that expire every Friday. More on that later on. But for this example, this option expires on the third Friday of December. So by buying this option, you have to pay a premium to the person who sold you this call option. And this premium, for example, would be $8. So this premium would only be a small percentage of the price, the strike price. In this case, about 4%. So what happens now? Let's imagine that now Microsoft indeed goes up in price. So Microsoft from $200, it goes up to $250 per share. Question, are you happy? Yes, you should be happy. Why? Because by buying this call option, you have locked in the price at $200. You have the right to buy the shares at $200, but it's now at $250. So theoretically, you could buy the shares at $200 and sell it in the market for $250, making a profit of $50. Does that make sense? Okay, which means your options have now a potential profit of $50 locked in. We call that the intrinsic value of the option. So your options are now worth at least $50. Now, in reality, it'll be worth a lot more than $50 because there could be time value left before expiration. So it could be worth more than $50, but it'll be worth at least $50. We call that, again, the intrinsic value. So you bought the option at $8, correct? And now the option is worth $50 at least. So what could you do? You could sell the option at $50. So you bought the option at $8 and now you sell it at $50. How much money do you make? You make a $42 profit. So you can see that in reality, as option traders, we don't actually exercise the option and buy the 100 shares. Let me repeat that. In reality, the majority of people who trade options, they don't want to own the shares. They don't want to actually buy the shares. Why? Because if they actually buy the 100 shares, it's going to cost a lot of money to buy the shares. So instead, they want to buy the option and resell the option at a higher price. So when you buy the option at the price of $8, and the stock price goes up, your options are worth more. You resell the option at a higher price, you make $42. Does that make sense? Okay. Now, but what if after you have bought this call option, Microsoft fell from $200 to $199, and it stayed there by the expiration date, which means at expiration, Microsoft is at $199. Are you happy? No, you're not happy. Why? Because you have the right to buy Microsoft at $200, but now it's at $199. So why would you want to buy it at $199, right? So in other words, now your option becomes pretty worthless. Like, who the heck wants this option anymore? So at expiration, the option would be worth $0. So how much would you lose if you held the option all the way to expiration? You would have lost $8. So when you buy an option, the most that you can lose is the premium that you pay for the option. That's the most you can lose. But of course, in reality, we don't want to lose the entire $8. We want to sell way before expiration to salvage some of the price left. What if Microsoft went from $200, it went to $300 by the expiration date? Are you happy again? Yes, you're happy. Why? Because once again, this option gives you the right to buy Microsoft shares at $200. But now the price is at $300, which means theoretically you could buy the shares at $200 and sell it at $300 in the market, making a potential profit of, tell me, I can hear you. That's right, making a potential profit of $100. So now again, your options are worth at least $100. So usually they're worth more because of time value, but they're worth at least $100. And again, what do we call that? What do we call that? We call that the intrinsic value of the option, correct? So now the option is worth at least $100. And you're really happy. Why? Because you bought the option at $8, remember? And now that the option is at $100, you could resell that option. Bought it at $8, resell it at $100. How much money do you make? You make $92 in profit. So you can see that when the stock price goes up, the call option goes up in value. When the stock price goes down, the call option goes down in value. That's the takeaway. So write that down. Stock price goes up, call option increases in price, or increases in value, or increases in premium. Same thing. Now let's take a look at the entire transaction. So in the market, you can play two roles. You can either be the call buyer, the person who buys the calls, or you can be the person who sells the calls. So sometimes I buy calls, sometimes I sell calls. I take the roles interchangeably depending on my strategy and my objectives. Now the person who sells the call, he's known as a call writer because you write a call. It's like writing a contract. Okay. Now, common question I get would be, Adam, do I have to first own the shares to sell the call or to buy a call? No, you don't. Again, let me repeat. In options trading, we usually don't want to buy the shares. We don't need to own the shares in the first place. All we do is we trade the options. We either buy the options or we sell the options. Sell an option anytime, just like you can write a contract anytime, and you'll see how it's done in the practical part of the course. Okay, all right. So let's go back to this. So again, if you buy a call, you have to pay a premium. Remember, as a buyer, you always pay the premium. And who collects this premium? Well, the person who sold you the call. Now, it could be anyone, you don't care who it is. It could be your friend, it could be the bank, you don't care, right? So the person who sells the call to you receives that premium. Now, as a call buyer, what happens? You have the right. Remember, as a buyer, you always have the right to buy the stock from the call seller at the agreed upon price, which we call again the strike price. And again, in the market, you can choose any strike price you want. And you can choose any date to expiration you want as well. Many choices. So once again, as the buyer of the call, you want the stock price to go up. Remember, the higher the stock price goes, the more valuable the calls are. Stock price goes up, the call premium increases. So you can then sell the call at a higher price and make a profit. Buy the call at a low price, sell the call at a higher price. Now, for the call seller, why would he want to sell the call? Because he collects the premium. The call seller gets the premium. But by receiving the premium, the call seller is obligated. So always remember, the seller of the option is always obligated. He's obligated to sell the stock. Remember, one contract is 100 shares. So he's obligated to sell 100 shares to the call buyer at the agreed upon price, which again we call it the strike price. And so for the call seller, he would want the stock price to go nowhere, to remain at $200 or to go down. Why? What happens if the stock price goes sideways, like it stays at $200? What will happen to the call option? If the stock price stays at $200, the call option will eventually expire worthless. And once it expires worthless, the call seller no longer is obligated to buy the shares. Yes, I'm free of my obligation. And the call seller simply keeps the premium. Same thing, if the stock price goes down, the call option becomes worthless, and the call seller says, good, it's now worthless. I sold you something that became worthless. I'm no longer obligated, and I just keep the premium that I got from you. I have to emphasize again that when you buy a call, you have the right. So the right means you can choose to buy the stock or choose not to buy the stock. So you have the right to buy the stock, and if you want to buy the stock, you will exercise your option. So when you exercise the option, you will receive 100 shares. But of course, you have to pay the money for it. But like I told you, in reality, the majority of call buyers will never exercise the option. They will never exercise the option because they don't want to own the shares. They don't want to cough up the money to buy the 100 shares. They simply want to buy the call option and resell the call option for a higher price. Got it? And for the call seller, he doesn't have the right, but he has the obligation. Obligation means he has no choice. If the call buyer exercises the option, the call seller has no choice but to deliver 100 shares of the stock to the call buyer. So that's what we mean by obligation. Now let's take a look at how buying call options compares to buying the underlying shares of stock. So one of the advantages of buying call options is that it allows you to control large amounts of stock value with a small amount of capital. For example, let's imagine once again that Microsoft is now selling at $200 per share and you expect it to increase to $220 in the next couple of weeks. So what could you do? So scenario number one would, again, to just buy the underlying shares of stock. And let's imagine you want to buy 100 shares. So you pay $200 for 100 shares. That will cost you $20,000 in capital. And if Microsoft increases to $220, now your shares are worth 220 times 100, your shares are now worth $22,000. So if you sell your shares and take your profit, you will make a profit of 22,000 minus 20,000. Your profit will be $2,000. So you made $2,000 profit out of $20,000 in capital. So what is your ROI, or your return on investment? It'll be 2,000 divided by 20,000. That gives you a 10% ROI. So that's buying the shares itself. So instead, scenario number two we buy the call option that locks in the price. So in this case, we buy the Microsoft call options and we choose the strike price of $200, which means we lock in the price at $200. We have the right to buy Microsoft shares at $200 anytime before the expiration date. So we could choose whatever expiration date, could be 30 days, 40 days, whatever. More on that later on. So we buy the call option, and of course we have to pay a premium to buy the contract to lock in the price. So once again, the premium, it would be $8. So in this scenario, what is our capital outlay now? Now we only have to pay $8 times 100 shares. Again, one contract is always 100 shares. So if we buy one contract, it would cost us $800. So off the bat, you can see that with the call option, we only need $800 to control 100 shares versus requiring $20,000 to buy 100 shares. So it uses less capital. And in the second scenario, let's imagine Microsoft increases to $220 as well. So what are the options now worth? So again, remember, the option gives you the right to buy the shares at $200, but now it's selling at $220, which means you could buy the shares at $200 and sell it at $220, giving you a profit of $20 per share. Times 100, that'll be $2,000. So now your options are worth at least $2,000. We call that, once again, the intrinsic value of the options. Correct? And you bought the options for $800. Remember that? So if you now sell the options, you get $2,000 and you deduct the cost of buying the options at $800, your profit would be $1,200. So in this case, you made $1,200 profit, which is less profit than $2,000. But again, in this case, you only forked out $800. So you make $1,200 divided by $800. Your ROI, or return on investment, is 150%. So once again, the main advantage of using options is that you boost your return on capital from 10% to 150%. Now that sounds great, but what's the catch? There's always a catch. And the catch is when you buy options, there's an expiry date. So for example, if your options expire in 30 days, then the stock price has to go up within that 30 days. If it doesn't, what happens? Your options will become worthless and you can lose 100% of the premium. In other words, you could lose this entire $800. You could lose everything if it expires worthless. So in other words, when you buy a call option to bet on the direction of the stock, not only must you be right on the direction, but you must be right on time, which means that you must be right before it expires. And if the stock goes up, but it takes too long to go up, and you're right on the direction, but it expires before that, you lose everything. However, when you buy the shares itself, you don't have to be right in 30 days. You can wait for months or years until it goes up. So let me repeat that. When you buy a call option, you must be right on the direction and you must be right on the timing as well. It has to go up within that time, or you could lose the entire value of the options. But when you buy the stock, time is not working against you. You can afford to wait for a long time for the stock to go up for you to make money. And if the stock doesn't go up, it's cool. You still own that $200 stock. So because of that, I tell my students that you should never use options, or rather you should never buy options for investing. Because in investing, you know the stock will go up, but you're willing to wait for the long run. You should only use call options for short-term trading. Please write this down somewhere. You only buy call options for short-term trades where you want to get in and out within a few weeks. But you never use options, you never buy options for the sake of investment. Because as time passes, your options will lose value as it loses its time value, and within 30 days or 60 days, it would expire worthless and you could lose all your premium. Next, in trading options, it's important to know how to read what is known as the risk return chart or the risk reward chart. And this is what it looks like. So on the y-axis, we have got profit. On the x-axis, horizontal, we have got the stock price. So again, on the x-axis, horizontal, we've got a stock price. And on the y-axis, we've got profit or loss. Now, this is the zero line. Anything above zero would be profit. Anything below zero, you'd be making a loss. Now, when you buy 100 shares of a certain stock, what does the risk reward graph look like? It looks like one straight line. It's a linear line that goes this way. And for example, if you buy 100 shares of Microsoft at $200, this 200 would be your break even, correct? And if Microsoft, the stock price goes to 220, what happens? You will make profit. If the stock price drops below 200 to say 180, you make a loss. That's how this chart displays itself. So in this case, again, if Microsoft goes up by $20 and $20 times 100 shares, you make $2,000 profit. If Microsoft drops by $20 and you multiply that by 100 shares, you lose $2,000. So when you buy a stock, you can see that it's a one-for-one risk to reward. Price goes up $1, you make $1. Price goes down $1, you lose $1. Now, of course, theoretically, a stock could go to zero, theoretically. And if it goes to zero, you could lose the entire investment. But of course, we know in reality, if you buy shares of a fundamentally good business that's making money, that's profitable, then it won't go to zero, right? Apple won't go to zero, Microsoft won't go to zero, practically. But of course, in theory, if it does go to zero, the stock price goes to zero, then you lose your entire capital. So that's what it looks like when you buy 100 shares of stock. Now, but if you're to buy a call option, what does the chart look like? It will look like this. Ta-da! Okay. It looks like what I call a Nike sign. You know the Nike swoosh logo? It looks like that Nike swoosh logo. So a call option, when you buy a call option, it looks like this, where now the risk is capped, but the returns are still unlimited. Why? So in this case, again, we imagine you're buying one contract of Microsoft call options at the $200 strike price, and you pay a premium of $8. Now, when you buy a call option, what's the most you can lose? What's the max loss? The max loss would be the premium that you pay. At expiration, if the stock price drops or stays the same, you lose $8. Times 100 shares, right? One contract is 100 shares, that's $800. So you can see in this case, our maximum loss would be the premium that we've paid for the options, which would be $800. So this is $800. So we've got limited risk. Now, at the same time, if the stock price goes to infinity and beyond, how much could we make in terms of profit? If the stock price goes up, the higher the stock price goes, the higher the profits we will make. Remember? When stock price goes up, the value of the call options goes up. So remember, when you buy a call, it's always limited risk, unlimited return. Write this down somewhere. Limited risk, unlimited return. So there are three things you gotta know before you enter an options trade. First thing you gotta know is what's your maximum risk. That's the first thing. So I repeat once again, your maximum risk would be the premium that you pay. That's the most you can lose, which in this case would be $8 times 100 shares, $800. In reality, would I allow myself to lose the entire $800? No, I won't. Because if I enter an options trade, and the price is not going in my direction, I won't leave it to expiration to lose everything. I'm not that dumb. If I see that, hey, the price is not going up, usually I would sell the option before the expiration, so I don't lose the full 800 bucks. I may lose only 400 bucks, for example. But the point is, if I don't do anything, I can only lose 800 bucks maximum. So that's the first thing. You gotta know your maximum risk. The next thing you gotta know is, what is your break-even point? Now, when you buy a call option, the stock price has to move enough such that it covers the cost of the premium before you start making money. If the stock price goes up, but it doesn't go up enough, you could still lose money. So what is the break-even price? So here's the formula. Your break-even point would be the strike price plus the premium that you paid. So in this example, your strike price is 200, which means you have the right to buy Microsoft shares at 200, right? But the stock price has to go up above 200, and it must exceed the premium that you paid. It must cover the cost of the premium before you start making good money. So your break-even point at expiration would be the premium, $8. $8 premium plus the strike price, which would be $200 strike price plus $8 premium, $208. So can you see that $208 is your break-even point? The stock price has to go above $208 for you to make a profit at expiration. If it goes up to, say, $201, $202, $203, you still do not get to break even. Now again, bear in mind that I keep emphasizing that this chart that you see over here is at the expiration date. When we go into this in greater detail, you'll learn that we do not wait till expiration. We never wait to expiration. In fact, we tend to sell the option way before expiration. Because if you get out way before expiration, the option is still worth quite a lot more. It still has a lot of what we call extrinsic value. And when you do that, the break-even point is actually a lot lower. Again, don't worry too much about that. We'll cover that more in the subsequent lessons. But for now, know that at the expiration, the worst break-even point will be 208. Okay? Next, you need to also know before entering a trade, what profit do you expect to get at a certain point? So again, let's imagine that the stock price goes up to, from 200, it goes up to 220. How much profit do you make? In this case, you make 1,002. So how would you calculate 1,002? So the profit you make would be the stock price, where the stock price goes, minus the strike price, minus the premium that you paid. So stock price minus strike price minus premium. So in this case, what's the stock price? It goes to 220, right? Minus the strike price, which is 200, minus the premium that you paid $8, that gives you $12. $12 times 100 shares gives you 1,002. There we go, $1,200 in profit. And again, this is the profit you will make at expiration. But if you sell the option before expiration, you will make more than 1,002. And that's why, again, in subsequent lessons, you learn that you always sell the option way before expiration. In fact, we tend to get out about 30 days before expiration. Because if you wait to expiration, then your break-even price is higher and you actually make less money. Some of you may be wondering, hey, do I have to draw this graph myself? Do I have to do all this calculation like going back to school? Don't worry, you don't have to do any of this. All this is calculated automatically by the stockbroker, or the broker that you use, their trading software will do all this for you. And you just have to look at the prices to know your break even and how much you'll make when the stock price goes to a certain level. Let me show you an example right now. Here's a quick example. So over here you see this stock, Estee Lauder, ticker symbol EL, and you can see that it's on an uptrend, right? Wave up, wave down, wave up, wave down, wave up, wave down, and it looks like it is hitting this support and it's going to go, oh, it could be going up. So let's imagine that you are bullish. You think, okay, Estee Lauder is now at 250. That's the current price, and I think it's going to go from 250, for example, 250. I think that it could bounce back to maybe 270, for example. So I want to buy a call option. So if the price goes up, my calls would be worth more. All right, so let me show you what the chart would look like. So I go to trade. Now again, we'll go through how to use all this trading platform in the next few lessons. So don't worry if you're not sure how I'm getting the charts out, because I'm going to do it pretty fast right now, but we'll go through step by step in the subsequent lessons. Okay, so first thing is I'm going to choose an expiration date, and I'm going to choose, for example, the 19th of March, which will be in 63 days. So I've got 63 days to expiration. So I'm going to open that up, and you can see on my left are call options, on my right are put options. Let me just set it to just maybe 30 strikes. Okay. Or less, let's say 20 strikes. Okay. So right now, Estee Lauder's at $250, and I want to lock in the price right now. And I could choose the different strike price, whichever I want. I'm going to choose 250, which is right at the market price right now. So 250, I'm going to buy a call. Now, how much would it cost to buy the call option? You can see right now it's selling at $14.80 to buy the call. To sell the call, $12.30. So there's a big difference because the market's now closed. So the pricing is not that accurate. You got to wait for the market to be open for the pricing to be more reflective. I'm going to take the average of the two, which is about $13.55. Anyway, I'm going to click on the buy, and I'm going to click on this and look at the chart. There we go. There's our chart. Remember what I said earlier on? So that's your Nike sign. That's the Nike sign I was talking about. So again, if I buy this call option, it expires in about 60 days. And how much do I pay for this call option? It's not cheap. It's pretty expensive. You can see it's $14.80. So times 100 shares, that's $1,480. So if the stock doesn't go up, the stock goes down, and this option expires worthless, how much can I lose? You can look at the chart over here. That's the zero line, remember? Above that would be profit. Below that would be a loss. And on the x-axis, this would be the stock price. So the current stock price is 250. Stock price, we are aiming for it to go up to 270. But if the stock price goes down, then we could lose, right? So you can see right here, the chart will show there's a green line and there's a purple line. Now the green line is the profit and loss at expiration, which is the 19th of March in 60 days. So in 60 days, this green line would be your profit and loss. But today, your profit and loss today, which is the 15th of January, is the purple line. Again, we'll go through this in detail in the next few lessons. But what I want to show you right now is the maximum loss. So you can see that if you let it expire, if the stock price remains at 250 or it falls below 250 and you let it expire, it will hit the green line. And the green line, you can see the green line is 1480. So you lose the entire premium of 1480. Now, what's your break-even point? Remember your break-even point, which is the stock price. Oh, sorry, your break-even point is the strike price plus the premium. Your break-even point would be here, this red line over there. So you can see at expiration, your break-even point is roughly 264.75. Yeah, 264.75. That's the break-even point. So like I said, you don't have to calculate it yourself. The software will tell you your break-even point. It'll tell you your maximum loss. And you can also kind of like see that, okay, if Estee Lauder goes to 270, right? You can shift this around. If it goes to 270, how much money would I make? What's my profit? So my profit at expiration would be the green line. I make a profit of 528.75. Look at this box over here. Can you see this box? When I put my cursor here, you can see the one in green is the profit and loss at expiration, and the one in purple would be the profit and loss today. So if I put again the mouse here, you can see the green says 528.75. 528.75, right? So if the stock price goes to 270, that's the profit I'll make at expiration. But remember what I told you earlier on, that I will not wait to expiration. I would sell it much earlier. So you can see that if you were to sell it earlier, which is today, for example, the profit will be higher. Can you see that? Right? Because the purple line will move to the green line. As time passes, the option will lose extrinsic value. And we'll talk more about that later on. It will lose value until it turns to the green line. Let me show that to you right now. Now, over here you can see today's the 15th of January. So I'm going to click 16th of January, 17. Now, as I go forward in time, notice what is happening to the purple line. Can you see what's happening to the purple line here? That's right. So as time passes, the purple line falls until it becomes the green line at expiration. Can you see that? Pretty cool, right? Okay, so there we go. So the reason is the purple line has what is known as extrinsic value. And as time passes, the option will lose the extrinsic value, the time value, until there's no more time value left. It's left with the expiration. So you're going to learn later on that we will sell the option a lot earlier so that we actually have a higher break-even point. Right? You can see that right now, for example, it's the 15th of January. If the stock price were to go up in 10 days, that will be the 25th of January, for example, 25th of January, you can see that my break-even point would be there, the purple line. And if the stock goes to 270, you can see that I actually make more profit than waiting for expiration. My break-even point is lower, but at expiration it becomes higher. So that's why when you buy a call option, you want to sell it for profit or cut loss way before expiration. Again, more on this in the subsequent lessons, but for now, I want you to know that this profit and loss chart is something that you don't have to draw it yourself, you don't have to calculate it yourself. It's all done using the trading platform. Okay, so going back to the slides, you can see right now that this line is actually that green line, the profit at expiration. So in reality, when you do trade options, you actually have a purple line that is something like that. This is the purple line, where the break-even price is lower and you actually make more money if you get out early. But at expiration, the purple line will drop down to the green line eventually. Okay, great. So this is what it looks like when you buy a call option. Now, what happens when you sell a call option? Well, the chart will flip over. It'll be an inverse chart that looks like this. We just learned about buying a call and what the risk and reward chart looks like. Now, what if you sell a call? Once again, if you sell a call, the chart would be the inverse. It will look like this. There we go. An inverse Nike sign. So in this case, you sell one contract of Microsoft options at 200 strike price. And again, when you sell a call option, what happens? You collect the premium. You get the premium of $8 times 100, which is $800. So what does the chart look like? Looks like this. Now, when you sell a call option, what is your maximum profit? Your maximum profit would be the premium that you collected. You can't get more than a premium, correct? So again, if you look at the profit, the maximum profit that you see here would be $8 times 100, $800. Once again, the maximum profit would be the premium that you've collected, which is $8 times 100, $800. So as long as the stock price remains at $200, it stays at 200, or the stock price falls below 200 or stays there, you will keep that maximum profit. But what happens if the stock price goes up, way up to infinity and beyond? If the stock price, for example, from 200, it goes to 220, oh my God, look at that! You have a huge loss. So when you sell a call, it's the opposite. Limited reward or limited return, but unlimited risk of loss. The higher the stock price goes, the more money you will lose when you sell a call. So if the stock price goes to heaven, you go to hell. So you may say, in that case, why would anyone want to sell a call? If you sell a call, you get limited reward, but you could go to hell. Why would you want to do that? That is why you never sell a call option naked. If you sell a call option naked, you will be naked yourself eventually. Now, I sell call options all the time, but I don't sell them naked. I only sell a call option if I own 100 shares of stock to begin with. Then I'm covered, and we call that a covered call. Again, we'll learn more about that in the next few lessons. But for now, understand that if you sell a call without first owning the shares, you are selling naked. And if the stock price goes up, you are exposed to unlimited loss. So why does this happen? Let me explain it using a chart or using an illustration right here. Okay, so let's take, for example, Microsoft is now at $200 per share. And you decide to sell a naked call, which you should never do, but I'm just giving an example, all right? So you decide to sell a Microsoft call option at a certain strike price, which could be anything. So say you choose a strike price of $250. And by selling this call option, you collect a premium. And you collect a premium of, say, example, $5. Now, again, what happens when you sell a call option? You collect the premium, but when you sell a call option, you are obligated. You are obligated to deliver 100 shares of the stock at the strike price to the buyer of the call, if the buyer of the call exercises the options. I repeat that. Remember that? When you sell a call, you collect the premium, but you are obligated to sell the shares, to sell 100 shares at the strike price. So, what happens if Microsoft stays below $250? So the share price could go up, it could go sideways, could go down, but if it stays at $250 or below by the expiration date, then the call seller would be safe. Because what will happen if Microsoft stays below $250, at the expiration date, this call option will expire, worthless. And the call seller will no longer be obligated, and he will just keep his $5 premium. But the danger is, what happens if Microsoft goes way up? And say Microsoft goes to $500. What would happen to this person who sold the call? This person, could be you, right? Now the call seller is obligated to sell 100 shares at $250. But what if he doesn't have the 100 shares? Then he's forced to go into the market to buy the 100 shares at $500 and deliver it to the call buyer at $250. So imagine you gotta buy the shares at $500 and sell it at $250. So you would make a loss of $250. What if Microsoft share price goes to $1,000? This guy's dead. Because now he's obligated to sell the shares at $250, but he doesn't have the shares. So he has to go into the stock market, buy the shares at $1,000 and deliver it to the call buyer at $250. Imagine you buy the shares at $1,000, you sell it at $250, how much do you lose? You lose $750. So you can see that the higher the stock price goes, the more the call seller loses. So he's exposed to unlimited loss if the stock price keeps going up. So limited return of $5, but unlimited loss. So this is what we call selling naked. So you never sell naked. Now for me, before I sell a call, I ensure that I own 100 shares first. Now, if I have 100 shares, I'm safe. Then there's no worries. Why? So let's imagine that I already own 100 shares of Microsoft. And I bought it at whatever. Maybe I bought it at $150. Okay? So if I own 100 shares of Microsoft and I then sell this call option, then I've got no worries. Why? Because I sell this call option, I collect $5. If Microsoft stays below $250, I will get to keep the $5 and these options will expire worthless. I'm no longer obligated. But if Microsoft goes to say $500 or $1,000, what happened? Am I in trouble? No, because I already have the 100 shares and I can sell the 100 shares at $250. And is it okay to sell it at $250? Why not? I bought it at $150. If I were to sell it at $250, I still make $100. Plus, I get to keep my premium. So we call that selling covered calls, which means you sell a call, but you are covered. You have the 100 shares to deliver it. All right. So let me explain that one more time. Please write this down. Never sell a call by itself, because if you do that, you're selling naked. You've got unlimited risk of loss if the stock price goes to infinity. But if you already own the shares, no problem selling the call. Because no matter how high the share price goes, you already own the shares. So you can always deliver the shares to the call buyer at the agreed upon price and keep the premium at the same time. So if you don't own 100 shares in the first place, could you still sell the call in a safe way? Yes, you could. And that is only covered in the advanced option course, Iron Striker. So in Iron Striker, you're going to learn that, yes, you could sell a call and you could hedge this call by buying another call above that call. So in other words, you sell a Microsoft call at $250 and you buy another Microsoft call at say $260. And in this way, you are hedging your call. We call this a credit spread. Yeah, I know it sounds really complicated. It's actually really simple, but you learn it in the advanced course. So just remember for now, don't sell a call unless you have hedged it with owning the shares or buying another call to protect it. Okay, so coming back to the slides, let's repeat that once again, but using these numbers. So again, when you sell a call, the maximum profit is the premium collected, which in this case would be $8 times 100, $800. And as long as the stock price remains where it is, or the stock price falls, then you get the maximum profit. If the stock price goes up, like I said earlier on, the more the stock price goes up, the more money you lose if you don't own the shares, if you sell it naked. So what is the potential loss if you sell it naked? So the potential loss would be the strike price, which in this case is $200, minus the stock price, where it goes to, plus the premium. So you can see that the higher the stock price goes, the more money you will lose on this. Because strike price minus the higher stock price, the higher it goes, the bigger the loss. But you still get to keep the premium, of course, right? So example, again, if the stock price goes to 220, then your loss would be 200 strike price minus 220 plus $8 premium that you collected, you would lose $12 in total. Times 100, your loss would be $1,200. What's your break-even price? Your break-even price would be the strike price plus the premium you received. So in this case, strike price would be 200 plus the premium received would be $8. So the break-even would be 208 right there. So only when the stock price goes above 208, then you start to lose money. That's the break-even price. If it stays below 208 or at 208, you break even. Now again, this is assuming you're selling the call totally naked. If you own 100 shares first before selling the call, then you will not be exposed to any downside because you are covered. And again, we will learn this more on the chapter on selling covered calls. Okay, so here's a quick summary about what you've learned so far about calls. Okay, so again, for call options, you can buy a call option or you can sell the call option. If you buy a call option, your risk to reward graph is the Nike sign. And if you sell a call, the risk to reward graph is the opposite of the Nike sign. When you buy the call, you have the right to buy the shares. Always remember, when you buy a call, you have the right to buy the shares. When you sell the call, you're obligated to sell the shares. Okay? So as a call buyer, you profit when the price goes up. As a call seller, you profit if the price goes down or doesn't go up. In other words, it stays where it is, stays sideways or goes down, you make money. So, how do we profit from call options? There are only two ways to profit from call options. You either buy low and sell high, or you sell high and buy low. So, once again, the first way to make money is to buy a call and hopefully sell it at a higher price. Sell the call at a higher price. So example, if you buy a call at $1, you then want to sell the call at a higher price. What would make the call increase in price? That's right, the stock price goes up. Remember, the higher the stock price goes, the more valuable the calls become. So when you buy a call, you're hoping the stock price will go up and the premium or the price of the call will increase. So you buy low and you sell high. Now, what if the stock price doesn't go up? What if the stock price stays where it is or goes down? What's the most you lose? The most you lose is $1. When you buy a call, the most you lose is the premium that you paid. Limited risk, but unlimited reward. Higher the stock price goes, the more profits you make. The second way to make money is the opposite. You start by selling a call. Now, remember, you always want to sell something high and buy it back low. Or best thing is buy it back at nothing, right? Let it be worthless. Sell high, buy low. So you could start by selling a call. So imagine you sell a call at, say, $1, and you're hoping that the call will fall in value and become worthless eventually. So what would make the call go down in value? If the stock price falls or the stock price stays where it is. If the stock price stays where it is or it falls, the option will lose value day by day until it eventually becomes worthless or it's worth a lot less. So say you sell the call at $1, and from $1 the call loses value. Eventually it drops to 10 cents. You could buy it back at 10 cents. So you sell at $1, you buy it back at 10 cents, you make 90 cents. The best scenario, of course, if the call goes to zero, it expires worthless, then you don't even have to buy it back. Then you get the full dollar. All right. And what's the worst that could happen in the second scenario? The worst that could happen would be if the stock price goes up, you could have to buy back the call at a very high price and lose a lot of money. If you sell naked, so we say do not sell naked, remember? So if you sell a call but you own the shares and you have the shares to deliver, then there's no upside risk. So essentially these are the two ways you profit from call options. Okay, so now that we are done with call options, let's learn about put options. By the way, if you need to, do review the videos 2, 3, or 4 times before you get it. When I first learned options 15 years ago, I found it really challenging. I was lost initially. It took me like 3 months to get it. Maybe I'm a slow learner, maybe the guy who taught me is not too good. But my point is that if you find it challenging at first, it's pretty normal. It's not you, it is a tough topic. But once you get it, once you understand it, you don't know how you live without it, because it will completely transform the way you invest and the way you trade. So don't give up. Review it many, many times till you get it. And do send us emails to our team at support@piranhaprofits.com. We'll be happy to answer your questions to make sure that you understand this stuff. Okay? All right, so on to put options. So calls and puts. So when you buy a put option, you are buying a contract that gives you the right. Again, remember, when you buy an option, you have the right to exercise the option, but we never exercise the option in reality, all right? But you have the right. You have the right to sell. For puts, you're selling, right? So you have the right to sell 100 shares of the underlying stock at an agreed upon price. We again call that the strike price. And you can sell the shares at this agreed upon price anytime before or on the expiration date. And again, you can choose any date to expiration that you want. So let's take an example here. Let's imagine that currently Facebook is trading at $150. And you think that it's gonna go down. It's gonna drop to $120 or $100. And so what you want to do is you want to lock in the price right now. You want to lock in the sales price at $150. So you buy a Facebook put option with a strike price of $150, which means you now have the right to sell Facebook at this price of $150. You have locked in the sales price. And you can sell it anytime before the expiration date, which is the Friday of every week or every month. So again, this is the underlying stock, that's the expiration date, that's the strike price, there's a put option, and by buying the put option, again, you pay a premium. And the premium in this case would be, say, $5.80. Okay, so let's imagine once you buy the put option, Facebook indeed goes down in price. So Facebook, say, drops to $120. Are you happy? Yes, you are happy. Why? Because you have the right to sell Facebook shares at $150, but now it's at $120. So theoretically, you could buy shares from the market at $120 and sell it at $150 to the put seller. And if you buy it at 120 and sell it at 150, how much money do you make? You make $30 profit. So in other words, your option has now an intrinsic value of $30. Your options are worth at least $30. In reality, they are worth a lot more because of the time value, but they are worth at least $30. So remember, you bought the option at $5.80, but now this put option you bought increases in value to $30. So what could you do? You could sell the option for $30 and you make a profit of 30 minus 580. You make a profit of $24.20. So once again, you can see that although by buying the put option, you have the right to sell the 100 shares of stock, you don't actually sell the 100 shares of stock. Remember what I told you? In reality, the majority of people who trade options, they don't actually want to buy the shares or to sell the shares. They just want to trade the options. They want to buy the option and resell the option at a higher price. So in this case, again, you buy the put option at $5.80 and you resell the put option at $30, making a profit, and you do so without ever exercising the option and actually selling the shares. Why? Because you don't even own the shares in the first place. A common question people ask me is, Adam, do I have to first own the shares to buy a put option? No, you don't. You don't have to own the shares. Okay? You can just buy a put option and resell it at a higher price. Now, what happens if Facebook goes up instead? It goes up to $151. And by expiration by expiration, it stays at 151. What happens to the put option now? Now you're not too happy, right? Because you bought the put option and you have the right to sell the shares at 150. But now the shares are at 151. So this put option becomes pretty worthless. So at expiration, the put option would become worthless. And how much would you have lost if you had held it to expiration? You would have lost $5.80. So again, same thing. When you buy a put option, the worst that can happen is you lose the entire premium. But in reality, we will never allow ourselves to lose the entire premium. Okay, we would sell the put option and get some money back before it expires worthless. Got it? All right. Now again, what would happen if Facebook were to drop? Say theoretically, Facebook goes to zero. Right? Of course, that won't happen in real life. But let's say the company goes bankrupt and the shares go to zero. Are you happy? Yes, you're really happy. Why? Because by buying the put option, you have the right to sell Facebook shares at 150. But now it's at zero. So theoretically, you could buy the shares at zero and sell it at 150 to the seller of the put. And how much money would you make? You would make $150, right? In theory. So now your put options are worth at least $150. That's the intrinsic value of the put option now. So from 580, boom, your put option is now worth 150. How much money would you make? You would make 150 minus 580. You'd make $144. Of course, that won't happen in real life. I'm just giving a theoretical example. All right. So write this down. Basically, for put options, what happens? The lower the share price goes down, the value of the put goes up. And the more the share price goes down, the more money you make on the put option. It's the opposite. So once again, in the marketplace, we can take on the role of a put buyer, or we can take on the role of a put seller. Sometimes I buy puts, sometimes I sell puts, depending on my objectives, depending on my strategy. They both have their own pros and cons. Okay, so first the put buyer. So as a put buyer, you buy a put, and you pay the premium. Remember, the buyer of the option always pays the premium. And once you buy the put, you have the right, as a put buyer, you have the right to sell 100 shares of the underlying stock to the put seller at the agreed upon price, which in this case is 150. So for the put buyer, you want the stock price to go down. The lower the stock price goes, the more your put options are worth. Remember that? Okay. Now, the person who sells the put, why does he want to sell the put? Because every time you sell an option, you collect premium. So the put seller collects premium. But in receiving the premium, the put seller is now obligated. He's obligated to buy 100 shares of the stock from the put buyer at the agreed upon strike price, which in this case is 150. So for the put seller, once he receives the premium, he's obligated to buy the shares at the strike price if the put buyer exercises the option. If the put buyer exercises the option and says, okay, I exercise the option, I want to sell my shares at 150, the put seller has no choice, is obligated to buy the shares at 150. So generally, the put seller, he wants the stock price to stay where it is or go up. Okay, why? If the stock price stays at 150, or if the stock price goes up, what happens to the put option? The put option will lose value, and eventually the put option will expire worthless. And once it becomes worthless, the put seller is no longer obligated to buy the shares. So no more obligation, and the put seller just receives the premium. So that is the scenario for the put seller. Once again, let's visit the risk and reward charts to understand what's the risk and reward in buying and selling put options. Okay, so once again, remember, on the y-axis, you have profit and loss. So that's the zero line. Anything above that would be profit. Anything below that would be a loss. On the x-axis, you have the stock price. So stock price goes up, stock price goes down. Now remember, when you buy a call option, it's the Nike sign like that. Remember that? And when you sell a call, you flip that Nike sign this way. When you buy a put, it's a kind of like a mirror image of the Nike sign. So when you buy a put, it's like that. All right, it's like that. Okay. So when you buy a put, what's the maximum risk? The maximum risk would be the premium that you've paid for the put. In this case, you paid $5.80, and one contract is 100 shares, so the maximum risk would be $5.80. That's the worst that can happen. So in this case, you can see a maximum loss would be $5.80. So if the stock price remains at 150, or if the stock price goes up, then the put option becomes worthless. At expiration, you lose the maximum of $5.80. That's if you hold it to expiration. And as I mentioned earlier, in trading options, we don't allow it to expire worthless. We will tend to get out before expiration, so we don't lose the maximum. But the max in this case again is $5.80. So limited risk. So again, when you buy a put, risk is limited if the share price goes up. If the share price goes down, if the stock price goes down, your puts become valuable, right? Share price goes down, you start making money, you make a profit. So how much profit do you make? So the profit that you make at expiration, again, note that the lower the stock price goes, the more profit you make. And of course, the stock price, theoretically, if it goes to zero, you make the maximum profit. So your profit would be the strike price minus the stock price minus the premium. So again, the lower the stock price goes, the lower this guy goes, the more money you make. So in this case, say the stock price drops to 130, how much money do you make? You take the strike price, which is 150, minus the stock price, which is 130, minus the premium that you paid. That will give you $14.20 profit. Times 100 shares per contract, that's a profit of 1420. So you can see the profit would be 1420. Again, for you to make money, the stock price has to drop enough. It has to drop below the strike price by at least the premium that you paid. So what's the break even? The break even price would be the strike price minus the premium. So the strike price, 150, minus 580, the premium, gives you a break even of 144.2. So the stock price has to drop below 144.2 before you make money at expiration. Even if the stock price drops, but not enough, you don't make money at expiration. And like what I showed you for the call side, remember that this chart is at expiration. But before expiration, you would see that the chart looks like that. Remember the purple line I showed you earlier using the software? Would be something like that as well. Because before expiration, the put option has what is known as time value or extrinsic value. So if you sell the option earlier, you actually make more money. You will actually make more money than what you see on this green line. And if you sell the option earlier, your break-even price would actually be higher than it would be at expiration. So when would you want to buy a put option? There are two scenarios. The first scenario is you are speculating that a certain stock price will drop. So for some reason, if you think that Facebook is going to crash and you want to profit on that, you buy a Facebook put. So when Facebook shares drop, the value of your put increases, and so you sell your put at a higher price and you make a profit. And you have never owned the Facebook shares, you're just betting on the drop of Facebook. That's the first scenario. Second scenario could be that you own Facebook shares and you think that in the short term the price could go down, so you want to lock in the sales price, and so you own 100 shares of Facebook, and at the same time you buy a put option on Facebook at the current price, the strike price of say 150. So by doing that, if Facebook shares drop below 150, you can still sell your shares at 150. So it's kind of like you own the shares, but you have locked in the sales price. So you have no concern if the share price drops, you can still sell it at 150. And we call that buying a protective put, because you're buying a put to protect your shares. And we'll learn more about that in the subsequent lessons. Okay, so what if you sell a put? So if you sell the put, now you will flip this chart from like that to like that. And this is what it looks like when you sell a put. So in this case, you're selling, again, one contract of Facebook put option at 150 strike price. So remember, when you sell a put or you sell any option, you collect a premium. And what's the maximum profit in this trade? Your maximum profit would be the premium that you collect. So in this case, the maximum profit would be the premium collected, 580 times 100, $580. So there we go. This is the max profit. So after you sell the put, if again the stock price remains at 150 or the stock price goes up, what happens? The put will be worth less and less and less. Eventually the put will expire worthless and you're no longer obligated to buy the shares anymore, and you will get to just keep that premium. Remember, when you sell a put, what's happening? When you sell a put, you are obligated to buy the shares at the strike price. You have the obligation. So if the stock price goes up or stays where it is, you are no longer obligated to buy the shares because the option will be worthless at expiration. But if the stock price goes down, the stock price goes below 150, you'll be obligated to still buy it at 150. Does make sense? So the lower the stock price goes, the more you lose potentially. Because imagine, if the stock price drops to 130, what does it mean? It means theoretically, at expiration, you are obligated to buy the shares at 150. And if you don't want to hold the shares, or you can't hold the shares, and you sell it at the market price at 130, how much do you lose? You buy at 150, you sell at 130, you lose $20. But you keep the $5.80 premium. So $20 minus $5.80 would be $14.20. And times 100, you would lose 1420. So the potential loss of buying a put is when the stock price goes down, how much would you lose? You will lose the stock price, which is 130, minus the strike price, because you buy it at 150, you sell it at 130, okay? And again, you lose $20, but you keep the premium of 580. So again, net loss would be 1420, which is 1420. What's the break-even price? The break-even price for selling a put would be the strike price minus the premium. So the strike price is 150. In this case, minus 580 will be 144.20. So at expiration, if the stock price drops below break-even, you will start to lose money on the trade. But even if the stock price drops, but it remains at or above 144.2, you are still breaking even. Now, at first glance, it may not seem like a good idea to sell a put because, again, if you sell a put, it seems that, hey, I've got limited profit, which is the premium, but I've got huge loss if the stock price collapses. It's a bad deal, right? Yes, it's not a good idea to sell a put if you are selling the put naked. And what that means is you sell a put, but you don't have the intention to buy the shares. Then it's not a good idea. Why? Because again, if you sell a put at 150 strike price, what does it mean? It means you're obligated to buy the shares at 150. And if you do that on a lousy stock, for example, that you don't intend to buy and the stock really collapses because it's overvalued or it's a speculative stock, okay, what happens? And if the stock price drops to 130, then you are obligated to buy the shares at 150 and then you sell it at 130 because you don't have the power to hold the shares. You buy at 150, you sell at 130. Again, you lose $20. And although $20 minus 580, you still get the premium, but you make a big loss. And that's why you see there's a big loss there. So again, I repeat, you will only suffer this loss if you sell a put and you don't have the ability to hold on to the shares. So if the put gets exercised, you're obligated to buy the shares at 150, and then you have no choice, you have to sell it at 130, you make that real loss. Or if you sell the put, and remember, when you sell the put and the stock price drops, what happens to the value of the put? The value of the put goes up, right? Stock price drop, put goes up. So if you sell a put, stock price drops, price goes up, and you have to buy that put back. You have to buy back the put to cover your trade, then you could make a big loss as well. So that is why we don't sell puts naked. Now for me, I make a living selling puts. I make a lot of money selling puts, but I do it covered. So what it means is I only sell puts on good companies, because when you sell puts on fundamentally good companies, you know these companies are not going to go to zero. These companies will not drop that much, like, Facebook, Microsoft, Coca-Cola. These are great companies. They may drop a bit, but they drop a while and they'll go up higher. So for these companies, I sell puts on them, and I have the cash ready to buy the shares. And I'm happy to buy the shares because they're good companies. And in that case, we call it a cash secured put. And when I do that, it is very, very safe because I'm doing it on a good company where I don't mind buying the shares at the strike price anyway. So let me give you an example over here. So let's say, for example, there's a good company called Facebook, and you know that this stock, it will go up eventually because it's making a lot of money. It's a great company, and right now, Facebook is selling at, say, $180. And you want to buy the shares when it's cheaper, when it's undervalued. So in that case, if you have the cash ready to buy 100 shares, you could sell a put quite safely because we call it a cash secured put. You have got the cash to get ready to own the shares. Then that's fine. So in this case, I could sell a Facebook put option at the strike price of 150. And again, when I sell a put, what happens? I collect a premium of $5.80, for example. So once I sell this put, I'm obligated to buy the shares at 150 if the share price goes below 150 by the expiration date. So if it does, so let's say Facebook shares drop and it drops to $140 by the expiration date. What happens? So in this case, the put I sold will be exercised by the put buyer. So now I'm obligated to buy the shares, to buy 100 shares at $150. Okay? So I will have to pay $150 to buy the shares, but I get to keep the premium, which I collected. So minus 580. So that's 144.20. So I have to cough up $144.20 times 100 to buy the shares. So now I own the shares, and I'll just have to wait because if it's a good company, I just wait. I know eventually the share price will go up and I'll be profitable, and it's fine. It's an investment. So in this case, selling a put is fine because you're selling a put on a good company you want to own anyway. In lesson 6, I'll teach you more about this technique called selling cash secured puts. However, you could lose a lot of money selling puts if you don't have the cash to buy the 100 shares, especially if you sell a put on a stock that's a lousy company that's losing money and the stock price could collapse. Then selling a put could lead to huge losses. So for example, again, let's imagine that Facebook is a lousy company. Imagine, right? And you don't have the cash to buy 100 shares, but you sell the put. So what happens? So you sell the put at the 150 strike price and you collect the premium of $5.80. And this time Facebook drops again, right? It drops to 140, for example. And because you don't have the cash to actually buy the shares, what happens? Then you have to close the put for a loss. You have to close the put for a loss. So you sold the put, you have to buy the put back to close the trade. Or you'll be forced to own the shares, which you don't have the cash. So you have to buy the put back. Now, but what has happened to the put? Again, you sold the put at 580. You collected 580, right? But when the share price drops, what happens to the value of the put? Remember, when the share price drops, the value of the put goes up, right? By how much? So in this case, if the share price drops to 140, you can see that the put will be worth at least $10 because the buyer of the put has the right to sell the shares at 150 and buy it at 140. In other words, he could buy the shares at 140 and sell it at 150. So the puts have an intrinsic value of $10. So now the value of the puts are at least $10. So what has happened now? So now you have to buy the puts back. Now you sold the put at 580 and you got to buy it back at $10 to close the trade. So how much do you lose? You lose $4.20. Okay. What if the shares of Facebook drops to 120? Because say Facebook's a lousy company, is losing money, for example, it drops all the way to 120. Then now the put will go up to $30. Remember, stock price drops, the put keeps going up in price, and you got to buy that put back, all right, to cover the transaction. So you sold the put at 580. Now you've got to buy the put back at $30. My God, how much you lose? You lose $24.20. So the more the share price drops, the higher the put goes. You've got to buy the put back at a higher price. You can make massive losses. So again, this only happens if you have to buy the put back because you don't have the cash to own the shares, and especially if you do it on a stock that could drop and never come back because it's a lousy company. So don't ever sell puts on lousy companies, and don't ever sell puts if you don't have the cash to own the shares. Okay, so to summarize what we've learned about put options, how do we profit from put options? Again, there are two ways. The first way is to buy a put and sell it at a higher price. So for example, you buy a put at $1 and you want to sell it for more than $1. So what would make the price of the put go up? That's right, the stock price goes down. So you buy a put, stock price goes down, the value of the put goes up, and you resell the put for profit, right? Buy low, sell high. Now, what if you buy the put and the stock price doesn't go down? The stock price goes up or stays the same. Then the put would expire worthless. And what's the worst you could lose? What's the most you could lose? That's right, you lose $1, the premium. So limited risk, unlimited return in buying put options. The second way to make money in puts would be to start by selling a put or writing a put. So you want to sell the put and buy it back, or not buy it back at all if it's worthless. That's the best scenario. So remember, you want to sell high and buy low, or not even buy it back, right? So when you sell a put, we call it again writing a put or shorting a put. So if you sell a put at $1, you're hoping that that put is going to drop in value. Okay. Now, what would make the put drop in value? If the stock price goes up, right? If the stock price goes up or stock price goes sideways, the put will fall in value until it's worth less and less. So, for example, if the put falls to 10 cents, you can then buy the put back. So you sold it at $1, buy it back at 10 cents, you make 90 cents. Of course, the best case scenario is if the put eventually becomes worthless at expiration, becomes zero, you don't even buy it back and you keep the full $1. Now, what happens if the stock price drops, right? You sell the put and the stock price drops. Then the price of the put will go up. And if the price of the put goes up, for example, from $1, the price of the put goes up to $3, then you have to buy back at $3. So you sell at 1, buy back at 3, you lose 2. All right? If the stock price drops even more and the put goes up to $5, then you sell the put at 1, you buy it back at 5, you lose $4. So the more the stock price drops, the higher the put goes. You have to buy it back at a higher and higher price. You could make huge losses. So that is what happens if you sell the put naked, right? But like what I mentioned earlier on, that if you have the cash to buy the 100 shares, then you're not selling naked. And that will be fine because you don't have to buy the put back. You can just sell the put, let it expire, and you just take on the 100 shares and you don't have to buy the put back. So these are the two scenarios for put options. Okay, so we're coming towards the end of lesson 1, and I do admit it's been a pretty long lesson because we had to cover a lot of the basics of how options work. But I hope that, again, you've got a pretty clear idea right now. And if you need to, like I said, review the lesson twice, 3 times, 4 times, whatever it takes for you to understand it. And you got any questions, send us an email at support@piranhaprofits.com. Like I mentioned before, when I first learned options 15 years ago, I found it really challenging myself. I was lost. It took me a couple of months before I got it. But once I got it, it became really simple. It's like riding a bicycle, you never forget it. And it changes your investing and trading life forever. And you would never know how you lived without it. Okay? So like I said, don't give up. If you find it confusing at first, review it and you will understand it. You will. All right? Great. So we've just completed lesson 1. And let's see what else we're going to cover in this Iron Shell Level 1 course curriculum. So in lesson 2, you'll be learning how to set up the charts and the trading tools. How to set up the charting platform, which I showed you earlier on very quickly. How do you create a watch list? How do you read and analyze an option chain? How do you analyze the risk to reward graph? How do you use probability analysis? And how do you place and modify your trading orders? How do you enter a trade? How do you exit a trade? All that will be covered in lesson 2. And then we go on to lesson 3. So lesson 3, we begin the strategy section. How do you actually use options to profit, right? So lesson 3 is the simplest way to trade options. Simply buy a call or buy a put. That's it. We call it long calls and long puts. It's the simplest way to trade, but it's the most expensive and you need the price to move a lot for you to make significant profits. So again, you'll be learning all the entry and exit rules and trade management rules of simply buying long calls and long puts. In lesson 4, you'll be learning how do you generate extra income for your investment portfolio by selling covered calls. So you sell call options that are covered by first owning the stock. And we'll go through again all the rules on how to do that profitably. Yeah. Lesson 5 would be how do you hedge your investment portfolio using protective puts. So once again, in the short term, markets go through corrections. Market goes through bear markets for a few weeks, a few months. So how do you generate short-term profits as the market goes down and use the profits to buy more good companies at a lower price? You'll be learning how to do that in this lesson. And how do you use put options like an insurance policy on your portfolio? Lesson 6, one of my favorite approaches, which would be how do you buy stocks of your favorite companies at a discount or even eventually for free. And this is Warren Buffett's favorite strategy. That's right, he uses this the most. We call it selling cash secured puts. And again, all this comes with a lot of case studies, a lot of real life examples. Then in lesson 7 and lesson 8, you'll be learning how to use options for short-term swing trading. So for example, if you want to take a long trade in the market, you think that, okay, the stock's going to go up, I want to take a long trade, you will buy vertical call spreads. Now remember that when you buy a call itself, it's very expensive. It can be really expensive and it loses value every day. So how do you reduce the cost of buying a call and reduce the effect of theta decay, of the time value being lost? You use what is known as a call spread, also known as a bull call spread, and it looks something like that. All right. So we buy a call and then we sell another call at our profit target, and we sell the call and we use the premium from that call to finance part of the call that we buy. So it's a brilliant strategy. You're going to learn that in lesson 7. Lesson 8, if you're betting on the stock going down, instead of buying a put, you buy a put spread. We call it a bear put spread. Again, that lowers the cost of the trade and reduces the effect of time decay. So lesson 7, lesson 8 will be very useful in your swing trading strategies. Okay, this is also known as a bull call spread, and this is also known as a bear put spread. Then in a bonus lesson, you'll be learning the basics of technical analysis. Now, for those of you who may not have taken my professional stock trading course or my investing course, you may not have an idea how do you read the market trend. Like, is it an uptrend? Is it a downtrend? What's a support level? What are moving averages? So for those of you, this is a bonus lesson to teach you the basics of how do you read the market, to know when to go long, when to go short, when the market is going to sideways, right? So you'll be learning all these techniques, how to identify trends, using support and resistance, moving averages, and using specific indicators and candlestick patterns. So that concludes lesson 1 of the basics of options trading, and I'll see you guys in the next couple of lessons. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.